This week we will learn about derivatives and hedge accounting. Today's business world is very globalized and complex. Businesses need to face different uncertainty, risks, and volatility, but no businesses like to face those uncertainties, and that's why businesses invest in special type of financial instruments which are known as derivatives. These derivative instruments help business to deal with the uncertainty, risks, and volatility. So the name of those instruments are derivatives because the values of those instruments are driven by the values of other assets such as stock, bonds, or commodities. Companies use the fair values or cash flows of these instruments to offset the changes in the fair values or cash flows of these assets, and this is how they deal with uncertainties. There are different type of derivatives. The most common derivatives are forwards or futures, options, and swap. What is a forward or future? So a forward contract is a contract that a company sign into, and they can purchase a stock in future at specific price. So if you believe that Google's stock price will increase in future, but you don't want to face that in the price increase risk, or you may want to make some gain because of that stock price increment, you can sign a forward contract with a broker and you can lock into a price to buy Google shares. So this is how you can fix the price of the share that you will buy in future. On the other hand, options is pretty much same like the forward contracts, but for an option, the company signs the contract and the company will buy a specific stock at a specific price, but it is the right, not obligation. So there is a difference between forward and options. Forward is an obligation. When you sign the forward contract, you are obligated to buy that stock at that price. On the other hand, options are just optional. You have the right, if you want, you can exercise the option and you can purchase the stock at a certain price. If you don't want, then you don't need to. On the other hand, swaps are very interesting. This is an agreement between two parties that help them to offset the risk when the two parties have different perceptions about the price of a specific stock, bonds, or commodities, or it could be also interest rate. So in this chapter, we will first learn who uses derivatives and why, different type of derivatives, and especially the accounting part. Now, who uses derivatives and why? There are two major groups of businesses they use derivatives. One group, they are the producers and the consumers, and the other groups are the speculators and arbitrageurs. So producers and consumers basically want to reduce the fluctuations in the commodity price. For example, you are a manufacturing company, you need to purchase raw materials, but for different reasons the price of the raw material may fluctuate, and you don't want to face the fluctuations or volatility because that will also impact on the cost related to those raw materials. So you can lock into a fixed price when you purchase those. On the other hand, if you are a seller, you may also want to lock into a fixed selling price so that because of the different factors and supply demand conditions of your goods, you don't need to face any uncertainties in the market. For example, a crop producers, a farmer who produces corns or potatoes, and depending on the weather, the production amount may vary, and that will impact on the demand and supply side of the market, and that will also impact the price of the products that they are producing. And this is how producers and consumers They use different type of derivatives to reduce the risk related to the commodity or product price related fluctuations. For example, different airlines, Delta, Southwest, or United, they use jet fuels, and the fuel price may vary. There might be different several factors, micro and macroeconomic factors, international factors that they cannot control, and they may need to face different fluctuations and risks related to the price, and they can lock into a fixed price and can reduce their risk exposure. So these are the producers and consumers, and they frequently use different derivatives to reduce the risk related to the volatility. Another groups that use different derivatives, they are known as speculators and arbitrators. So these group of people basically want to make money by using these financial instruments and derivatives. So speculators are the group of the people who speculate the price of a stocks, and based on their speculation they want to make money, and they just hold buy and hold the stocks for a few hours and they sell it. This is how they speculate. If they speculate, the price of the stock will go down, and they can make their strategy in that way, or go up high or down. They can make their strategies that way, and they can make money from the market. On the other hand, arbitrators, they also invest in these derivatives just to make money, not for their own commodities and products that they are manufacturing or producing like the other group of businesses. Rather, they try to take the advantages of the market inefficiencies. That means if they see that the same product or same commodity or any other financial instruments are being traded at two different prices in two different markets, then they will buy from one market at a lower price, and they will sell at a higher price into another market, and this is how they will make gain. So now here we will learn about the basic principles in accounting for derivatives. So GAAP tells that you have to record derivatives. If as a company you invest in derivatives, no matter you are the consumer, producer, arbitrageurs, you have to record those in your financial statement. You have to recognize those as assets or liabilities depending on the exposure, and you have to record all derivatives at the fair values, and you have to also record any gain or losses related to those derivatives, and you have to record those immediately so that it reflects in your income. On the other hand, if you do some hedging, and if you make any gain or losses from those hedging, you also need to record those. Now, depending on the type of hedges that we will learn soon, you have to show those gain or losses either in the income statement or in your balance sheet under the stockholders equity part, labeling under OCI. So there are two types of hedging. One is called cash flow hedging, another is called fair value hedging. If it's fair value hedge, that gain or loss you will show it in your income statement. On the other hand, if it's cash flow hedge, you have to show that cash flow hedge gain or losses directly under the stockholders equity part. Now we'll see several examples, especially how we will do the journal entries and record those financial instruments in our book. So everything will be from an investor's perspective. All are institutional investors or businesses or companies that are purchasing or investing in these financial derivatives. Let's see one example of a derivative, and it's about call options. You have some idea about call options. Call options are this special type of financial derivative instrument that gives a right to purchase a company's stock at a specific price. So now if as a company or business you purchased other company's call option, how you gonna record that? A company purchases call option contract from Baird Corporations on January 2nd, 2025, and this gives the options or the right of that company, the purchaser company, to buy Laredo company's stocks at $100 per share. Now, you as an investor in these options, you will see if Laredo's stock goes up above $100, then you will of course buy Laredo's stocks at $100 and you can sell those at a higher price and you can make money. But if you see that Laredo's stocks price is not going above $100, then you don't need to exercise those options. So this option contract gives the purchasers to exercise or purchase 1,000 shares, and every option has some expiration date. That means you have to exercise these options within this time period from January 2nd to April 30th, and the company who purchased those call options, they paid $400 for all those options. So now the company will record the following journal entry on January 2nd, 2025. Call option debit, cash credit. Now here this $400 which we recorded as the option price is also known as the option premium. An option premium has two parts. One is the intrinsic value, another is the time value. Intrinsic value is the difference between the market price and the exercise or the strike price. So the company entered into the option contract on January 2nd, and their strike price or the exercise price to purchase Laredo's each share was $100, and we assume that on January 2nd Laredo's stocks are being traded at $100. That means on January 2nd the market price and the strike or exercise price both are the same. So basically we have $0 intrinsic value. On the other hand, we recorded here the $400 for the option price. So this entire $400 is because of the time value. So time value refers to the total option premium, and if you subtract the intrinsic value from there. So now what company will do? The company will prepare their financial statements at the end of the year or at the end of the quarter. When they prepare the financial statements based on the changes in the market price and the time value of the option, they will update the call option value. So call option was recorded as an asset on their balance sheet when they purchased those, and based on the changes in the market price and changes in the time value, the company will update the call option values, and at the same time the company will use unrealized holding gain or loss to adjust with those value changes. So on March 31st, the company prepares their quarterly statements, and the company looked at the market price of Laredo's shares, which is $120 per share. So now, based on that exercise or strike price, the intrinsic value for each option is now $20. So the company is actually making a gain $20, and for 1,000 shares, 20,000 shares, and the call option value is also increasing, so company will record that. And also the time value decrease. Originally the $400 was the entire time value, now it's $100, so we will also reduce this by $300. So on March 31st, the company will prepare these two journal entries to record the increase in the intrinsic value. For each share it was $20 multiplied by 1,000 shares. They will increase call option by 20,000, and at the same time, because of the share price is increasing, although they're not settling the options or purchasing the stocks or exercising it, still they are holding the stock, so they will record it as an unrealized holding gain, a credit item, and it's an income statement item. On the other hand, they will reduce the time value by $300 because on March 31st, the time value of the option is $100. So to reduce that, they will credit call option $300. Since the time value of the option reduced, it's a loss, and they will use the same account but they will debit it. Unrealized holding gain or loss, debit $300 and call option value credit $300. So now on March 31st, if you look at their balance sheet, originally the option was debited on debit side $400, and then because of the intrinsic value increased, and we also increased the option value $20,000, but we also reduced it by $300 because of the decrease in time value. So on March 31st, their balance sheet, if you do a small T account, their balance sheet will show, or the T account balance will show, that the option value is $20,100. They will also show that unrealized holding gain or loss in their income statement. And one part, because of the intrinsic value increment, they have again $20,000. On the other hand, because of the losing the time value of the call options, they will show the $300 loss. Now here the company settles the option on April 16th. Settle means that the company purchased those options from that investment company. So they basically do not like physically purchase those stocks at $100 and sell it and make gain. Rather, they actually settle those stocks from the company, investment company, that they purchased those options. So settling will be depending on April 16 date. So on April 16, if you look back here, the market price of each Laridas, each share is $115 and time value is $60. So based on this $115 and their previously adjusted market price $120, the company will record this intrinsic value related gain, or actually this time it's a loss because market price reduced by $5, and they will also reduce the option value because of the decrease in time value. So before settling it, the company will record on April 16 these value changes, and we'll see the journal entries on April 16. For each share, since the intrinsic value is going down, they will reduce it by $5 and multiply it by 1,000 shares. So unrealized holding gain or loss will be debit 5,000. Call option value is also reduced. On the other hand, time value of the call option also reduced from $100 to $60. So they will also debit it, and they will reduce the call option value by $40. Now for the settlement, again, they will just settle it with the investment company. So if you look at the T account or the option values at the end, you will see the option values change because of the changes in the market price or the intrinsic value and changes in the time value of the options. And right before the settlement, the option value balance is $15,060. So what they will do, they have to remove it. So they will credit this $15,060, and if you remember, the exercise price was $100 on April 16. The Laridas each share price is $115. So basically the company is making $15 gain if they would buy those share at $100 and sell it at $115, but they are not physically doing that, but they will record that $15 gain that they are receiving from that investment company from whom they purchased the options. So they're receiving cash $15,000 by settling that options. They will remove call option, and you will see, if you want to balance this journal entry, there still you have a loss, and that you have to debit it as the $60 loss on the settlement of the call option, because if you see the option value on your balance sheet or T account is $15,060, but you are receiving cash $15,000, so this 60 will be your loss. So now here they remove that call option from their balance sheet. Now if you look at the net impact, that they have on their net income related to the options. So basically they will show those option related gain or losses, and it was unrealized gain or loss, and then later at the end it was a settled option closing or settlement loss, and ultimately they are making a net income which is 14,600. So this March 31st unrealized holding gain or loss for intrinsic, it was $20,000 gain, and then for time value it was a loss, so net impact was an income 19,700. April 16 intrinsic value and time value both reduced, so they have a loss 5,040, and settlement date they have another loss on settlement 60. So if I take all these numbers, they still have a net income 14,600. This is how the company will record the option related income losses.